Hello everyone, I'm Sonak Roy. I welcome you to our channel, Team Edify. The main purpose of our channel is to help the people of India understand the necessity of investing. Why is it so important for every one of us to invest? Through this channel, we are trying to create this awareness. So friends, I would request you to please share, subscribe and like our channel so that everyone can benefit from this. In our today's video, we are going to discuss why it is important to keep investing or staying invested for a long period of time. So if you want to know the details in depth, please keep watching this video till the end. So friends, let us understand why it is important to invest, why it is important to invest all the time, and what is the importance of discipline in investment. So why it is important to invest? In this current situation where we see that the debt returns have come down to a level where if you invest in any debt product, it is not even beating the inflation. The inflation rate is more than the debt returns. So that way, if you invest in any fixed deposit or debt product, your money will degrow. What is the solution? You need to have a part of your portfolio to a place where you can see a consistent capital appreciation. That place is equity, majorly. There are many other asset class, but then equity is something that we would discuss as an asset class. Why investing in equity is good for you? When you invest in equity in long term, the returns that you can make, you cannot think of making that returns in any other asset class. For example, let us take example of Bajaj Finance. 2010, probably 11 years back, it was trading at around 70, 80, 85. What is the current price of Bajaj Finance? It's 6,200. Do you see the kind of returns, the kind of wealth this company has created in the last 11 years? Humongous. That's what it is. Can you think of this return anywhere else? Probably no. Now, I don't say that just look at this company. This is the similar kind of return, if not so much, but then at par or little less. But then most of the fundamentally strong companies will deliver you returns which is far better than any other asset class. They might not deliver you 600% returns in 10 years, but then yes, the expectation that you should have or keep from equity market is your money should be 10 times in 10 years. That is what it should be. How? Combining two things together. First, investing in fundamentally good companies. When you invest in fundamentally good companies and for a long period of time, you get the magic of compounding. Every 3 years, if you see any fundamentally good company, they generally have been increasing their earnings and your returns by average of 15 to 20% or say 25%. If that happens, your money actually doubles in every 3 years. So your 1 crore or 1 lakh or whatever amount you invest, say 1 lakh rupees becomes 2 lakh rupees in 3 years. Your 2 lakh rupees becomes 4 lakh rupees in 6 years. Your 4 becomes 8 in 9 years. This way, there is a magic of compounding which works in your portfolio. Amount invested is just 1 lakh rupees, but you have to let that investment stay in the market for a long period of time. And that is what creates magic. Now, when you invest, it also does a lot of good to our entire economy. Now, I believe and feel that it is not only the responsibility of the Prime Minister or the political parties to take care of the development of our country. It is our responsibility, our moral responsibility to contribute towards the development or the growth of our economy. So when we invest in these companies reinvest the money that we have invested in these companies in their business. In return, their manufacturing capacity increases or their servicing capacity increases. Whatever their sectors they are into, they perform better. Their numbers deliver better. And this way, they are contributing to the GDP of our country. So now you understand how important it is for us to invest in good companies. Good for us, good for everyone, good for the entire nation. Now, friends, I would take a particular example of this pandemic. So there are so many times we have seen where the market comes down, but let us take example of this pandemic in particular and learn from this. What should we do? In the last 1.5 years, we have seen a lot of ups and downs in the market. The market has seen all-time highs in the month of January 2020. From there, we see the market crashing down by around 30% in the month of March. Following that, right the next month of April, we saw a sharp recovery. And since then, the market has consistently been moving up and up and up. Today, we see the market at all-time high again. So we understand one thing, that nothing is permanent. Good times, bad times, they keep moving around. When it is good time, have patience. When time is bad, you should invest more. Why? When you are investing in fundamentally good companies and the time is bad, you are getting an opportunity to invest in small companies, in a good company in a smaller amount. The price comes down, your investment amount comes down. However, the company quality is amazing. That is the main idea. If you have a lump sum investment in the market and you see a correction in the market, stay invested. Don't take out your money at bad times. That is the worst thing to do. If you are a SIP investor, you are anyways benefited. Bad times doesn't last long. The time is good back again. But then if you have been investing with discipline, the past is an experience for you that you have made a lot of money. When the time was not good, you have got shares at cheaper prices, and when the prices came up, the number of units that you have accumulated have given you phenomenal returns. That is the way you make money. However, I also say that if you have money, if you have cash flow in your hand and the time is not good, the time is bad, it is the time to invest in good companies at a cheaper rate. That is the best thing to do. Again, take example from what happened few months back, a year back. In the month of March and April, if you would have invested in any fundamentally good company, you have actually doubled your money. That is the least return that you could have made. Every company, any fundamentally good company has doubled their returns. This is really what happens every time. You look back into the history and you will see that this is what has been happening every time the market has seen a downtrend. The market has shown a very sharp recovery. In that recovery time, it is the stronger players which has led that recovery. So again, friends, I would repeat or conclude my video with the thought process that insignificant of what the time is, keep investing. Investing is a discipline. It needs a lot of patience. Have that patience and trust me, the fruits that you will bear, you will enjoy that.